This is why a lot of other news agencies aren't picking up this story, is because this is old news. This is the product of what happened in December of last year. Canadian banks are preparing for massive pain in the credit markets. The Toronto Star is reporting that Canadian banks have now put aside $2.5 billion in order to prepare for credit losses, including those coming from mortgages. And the article suggests that they're preparing for a coming wave of expected loan defaults. And this comes on the heels of the big banks reporting their 2022 profits, which includes the sharing of their most recent financial statements. And those financial statements, of course, include the increased buffers with respect to the provisions for future losses. But are the banks really preparing for a loan default apocalypse, or is there something else to this story? Well, the answer is there is more to this story. And I'm going to talk about all of that in this video. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So go ahead and click that subscribe button and hit the like button so more people like you can see this video. And if you want to pick up my new book, Mortgage Secrets, for free, go to mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so this is seemingly a huge story that's only being picked up by one or two news outlets. So the question is, why is it only being picked up by a small percentage of the news outlets in Canada? And the answer is that there may not be as big of a story here as the Toronto Star is trying to make it out to be. And this falls under those guidelines of if it bleeds, it leads when it comes to the media. So a sensational headline like this is something that is definitely designed to attract readers. So like we tend to do on this channel, we took the sensationalized headline and now we're going to talk about what's really happening. And I think you will find this quite interesting. So make sure you stay till the very end to see what really happened that caused the banks to put aside $2.5 billion in the last quarter. So first and foremost, let me jump you into the article here. Canada's biggest bank set aside $2.5 billion to cover an unexpected wave of loan defaults. Banks say their credit losses will return to pre-pandemic levels as borrowers face higher interest costs and expenses. Credit card, car loan, and line of credit borrowers expected to be hit the hardest. Now, keep in mind that pre-pandemic levels piece, because that's going to be important a little bit later on here. But let's take a look at the article and see what they're saying. So first and foremost, Canada's largest banks have set aside that $2.5 billion. The big six banks, which reported fiscal first quarter earnings over the past week, all posted significant increases in such reserves called provisions for credit losses, compared to a year earlier when they totaled just $373 million. Now, this would lead somebody to believe, this would lead you and me to believe that the banks are preparing for massive defaults and that the banks are all acting prudently so that when the worst happens, which they are expecting to happen, they're prepared. So they're protecting themselves, right? That's the implication of this article. That is what it is written to make you believe. And they're missing out some key points here because that isn't what's going on. So make sure you stick with me here because this isn't exactly what's going on. The banks aren't predicting that there's going to be massive defaults and therefore all collectively are putting money aside. There's a little bit more to this story, but let's go a little bit deeper into this article here. It's the biggest buffers for credit losses since the first year of the pandemic. Keep that in mind here. This is going to get really interesting. When the financial giants also built up provisions before it became clear that the government financial supports and stockpile of consumer savings would help stave off a wave of loan delinquencies. But then the Toronto Star seems to pick up on the piece of the story here that they missed. But even though they picked up on this piece, they still didn't report on the full story. So bank executives said this week they don't expect a dramatic spike in defaults, particularly as employment remains high, but they anticipate what they call a normalization of credit loss trends. So even though the banks are putting away a massive amount of money, they don't expect that there's going to be a hike in defaults. So if they don't expect that there's going to be a hike in defaults, why would they be putting money away? This doesn't make any sense, right? I mean, it makes sense from the perspective of we all expect that something bad is going to happen in the future because that's what the media has been telling us. But it doesn't make sense from the perspective of they all think that things are going to be okay, but they're putting the money away anyways. Now, one thing I want to point out here, especially from a mortgage and real estate perspective, is that they're all saying that the risk of delinquencies on credit cards, lines of credit, and auto loans are more likely than mortgage defaults. And all of these types of defaults have already started in recent quarters. Mortgage defaults are at all-time lows, but the credit cards, the lines of credit, the car loans, which by the way are the things that get people into financial trouble and are the credit facilities that people who are buying things that they can't afford all tend to use. Those are the types of credit that are having increased delinquencies right now. And you expect that to happen. You expect that to happen before people stop making their housing payments. But here's the thing. They're suggesting that this $2.5 billion is abnormal. They're seemingly suggesting that this is something the banks are doing because they expect losses. But again, that's not what's going on here. And like I said earlier, this is the biggest amount of money that they've put away since pre-pandemic or in the first little while of the pandemic. But that would imply that they did that because of the pandemic, and that's not true. The banks put away $2.5 billion in the last quarter of 2019, pre pandemic, primarily because some defaults were starting to increase, but also because they were told to. In 2018, OSFI, the Office of the Superintendent of Financial Institutions, created a new rule that required the banks to carry a buffer in case of higher delinquencies. And keep in mind, this was done pre pandemic. And it was also done in order to create more security around the Canadian banking system. Even though there was nothing to suggest at that time that these things were needed, it was done in order to make sure that our banking system was bulletproofed. Because the one thing that Canada has going for it, among a significant amount of other things, is the stability of our Canadian banking sector. And one of the things that happened post financial crash in 2008 was Canadian banks started acquiring American banks. And those American banks inherently added more risk to the Canadian banks that own them. So OSFI created more rules around creating buffers in order to protect our Canadian banking system from things that could happen outside of our country and affect us internally. And thanks to Better Dwelling, you can go back and find this article from January 8th of 2020, and you can see that at that time they were increasing their allowances for delinquencies up to $2.5 billion. And this was again Q4 2019 pre-pandemic. So now, as we come out of the pandemic and as interest rates get higher, and things seem to be a little bit more scary with respect to the amount of payments that people have to make and the higher interest rates, well, now it seems prudent that the banks increase their reserves again to those pre-pandemic levels. But again, this isn't because the banks are doing this of their own accord. The reason why they've put this money aside was already reported in December of last year. This is why a lot of other news agencies aren't picking up this story, is because this is old news. This is the product of what happened in December of last year and what actually happened leading up to December of last year. And that is this. That was OSFI raising the capital buffers for big banks to 3% as OSFI determined that household debt risk rise. So the regulator in December, and probably a few months leading up to December, was advising the banks that they needed to put more money aside. They had until February of 2023, which is pretty much right now, in order to put significantly more aside for increased loan losses. And this was done, obviously, as any regulator would do, to probably what would be considered an extreme of what was necessary, because this was about protecting Canadians, protecting the big banks, and protecting our financial system. So it isn't a shock that the Canadian banks put aside $2.5 billion. They were told to by the regulators, and this all happened late last year. This isn't an indicator that delinquencies are up. This isn't an indicator that our banks are expecting everybody to not be able to pay their mortgages. This is simply a result of what happened last year. And unfortunately, the Toronto Star is reporting on this as if it's a big news story, and the reality is, it just isn't. The Canadian banks are preparing for massive pain because the regulator saw a reason to make them do so, and they are fulfilling their obligations under the regulator as Tier 1 banks. So the reality is, the story here is there isn't really much of a story. At this point, there's nothing to indicate that there's going to be significant numbers of delinquencies and foreclosures. Of course, that is something that's possible with the rising interest rates and rising costs across the board. But you have to keep in mind that the job numbers are still strong, which means most Canadians still have a job, which means they should be able to make their debt obligations, especially considering that most of them qualified for their mortgages at a significantly higher rate than what they're paying. So again, the news here is really there's no news. Now, that being said, everything that I just said doesn't negate the fact that some people are struggling, and it doesn't negate the fact that it's harder financially right now than it was a year ago or 2 years ago. But if we look back at that initial story where they talked about the delinquencies and where they're happening, which is car loans, which is credit cards, which is lines of credit, the advice that people need to hear is this. Car loans, credit cards, lines of credit are not your friend. If you're spending money that you don't have, you need to find ways to stop spending it. And for a lot of people, that means lifestyle changes. That means getting rid of the fancy new car with a car payment in exchange for something that's significantly less expensive and doesn't have a payment. And no matter what a car dealership tells you, it is exceedingly rare for you to have a higher cost of maintenance problems on a used vehicle than you would have in car payments on a brand new one. The math just doesn't compute. There are outliers, yes, where an engine needs to be replaced or a transmission needs to be replaced, and it becomes very, very expensive to make those repairs, but those are outliers. Those aren't the norm. Most people who drive used vehicles that are well maintained have significantly lower maintenance costs on an annual basis than what their car payments would be on a brand new vehicle. That's just the reality. And then on top of that, cutting back all of your expenses on the things that you really don't need to survive and not putting purchases on credit cards and lines of credit where you can avoid them is the single biggest contributing factor to making sure that you don't find yourself in a situation where you have a delinquency on a credit line. So the story here is no story, but if you want to see a real story, check out the video right here on Canada's real estate market and the 20% declines that are happening in some places, but not necessarily everywhere.